Good afternoon and welcome to Stock Talk. My name is Sean Kabak and I will be your host. Manitoba Agriculture is offering a series of livestock and forage webinars to help Manitoba beef producers. These webinars will run monthly until April. We're glad you can join us for today's presentations. If you have any questions during the webinar, feel free to submit them by typing them on your computer or smartphone, and we will address them at the conclusion of each presentation. Next week on February 20th and 21st, the Manitoba beef producers will be hosting their AGM in Winnipeg at the Victoria Inn. So I would encourage producers to check out their website to see the agenda and to register. There's always a great lineup of speakers and it's free to attend except for the evening banquet. A Sustainable Canadian Ag Partnership Program that was new last year and is continuing this year is funding for the Livestock Predation Prevention Program. So this would cover predator-resistant fence construction. The deadline to apply is February 27th, so you can check out Manitoba Ag's website for more info. The Wildlife Damage Compensation Program is offered by MASC and has two components. One is compensation for crop or feed damage and compensation for livestock predation. So producers have wildlife coming in, eating their stored feed or silage or standing corn for corn grazing. So losses in extended grazing, they can contact their MASC office. As well, livestock predation compensates producers for livestock losses from predators. The recent precipitation map is showing parts of the province starting to dry out, especially on the western side and the eastern side. And this will lead into producers that may be interested or should look more closely at the forage insurance programs, which we will be hearing about first. So we have two presentations today. One is a MASC forage and livestock price program update. And we have with us Jeff Legaarden of MASC. And with current strong cattle prices and market volatility and the possibility of US tariffs, livestock insurance is definitely worth looking at. So I'd like to welcome Jeff, and he can take over the presentation or start his presentation.
Thanks, Sean. Appreciate it. Somebody can let me know when I am up and running.
You just have to go to slideshow and it'll be good. Perfect.
Alrighty. Thank you very much. Thanks everyone for attending the Stock Talk today. Jeff Legaarden with MASC. I am the business development specialist as well as the livestock price insurance coordinator for Manitoba. So today we wanted to touch base on our forage insurance to start with. Obviously, the flexible and affordable year-round protection on all your forage crops. And it's been this way for a while, but sometimes what seems old is new again, and we need to refresh everybody's mind of what the program offers. So new for 2025, I just wanted to highlight a couple of things that were announced at Manitoba Ag Days. The increased dollar coverage for forage establishment insurance is what the big thing that we saw the increase on. So what used to be $80 an acre for establishing a crop is now up to $130 at the high dollar option, and the low dollar option is $65 from $40. So when you're establishing that crop and you get to the fall and you don't know if it's all there, if you've got forage establishment, we can come out, take a look at it, and make those values to represent what we've seen in the forage seed industry has been increased dollars. So along with that, under the forage establishment insurance, we've also added bird's foot trefoil to one of the insurable crops. And I didn't mention it when I first started talking, but we also have the polycrop establishment. For those that are looking at the other options of doing those multiple species, polycrop has been around for a couple of years, and the dollar values for establishment on it are the same as our forage establishment. So 130 from 80 and 65 to 40 on the new. Next, I want to talk about what our dollar coverage came in at for the forages, the two options we have. We've got the select hay and the basic hay. So on the select hay, we have the 5 different crop types within select for your forage coverage. And this year, the dollar values are basically the same as the year before, which is great to see when some of our forages when you're trying to sell it because of the volumes we had last year maybe are down, but MASC's happy to come back with these dollar values. So on the select hay for your alfalfa, straight up $234 a ton. So that's your coverage on that. And with select hay, each one of these are a separate crop. So your alfalfa grass is separate from your alfalfa, comes in at 193. Your tame grasses is 166. Your select sweet clover is 180, and your coarse hay is 133. Along with that, the other option we do have is the basic hay. So instead of taking them into 5 different crop types, we bundle all your crops into one coverage. And so the high dollar coverage for on the basic, when we take a bundle of your whole production, is going to come in at $117 a ton. So any shortfall, you would get the difference. And on the low dollar, it's 70. So we're happy to see those values still up there where they are. And just to go from there, I wanted to give you an example of what you could expect if you were in the program. We always talk about producers, when you get into the program, your coverage may not be where you think it should be. And that's fair, but without you telling us what you've done, and we can't give you coverage for what we don't know. So I went in and found a producer that had been in the program for a while and has been in the select hay coverage and recorded his production specifically to each group and what those coverages are. And I wanted to point out that a lot of people say the livestock get the short end of the stick and don't have the coverage that you would see the grain guy does on his canola or whatever. When you look at those values, and I want to highlight the alfalfa grass, 4 years or younger. This producer has $532 an acre coverage. This is based on 2024's, which should move forward, but we don't have our coverages out for confirmation yet. But when you look at that, $532 and the premium for alfalfa grass is $16.18. I want to highlight that because this producer probably doesn't have that coverage on his canola. And everyone thinks that that's the loss leader is a hay crop, where this producer is actually showing us that if you do everything right and you get those numbers into us accurately, you can have coverage to represent what is really a profitable crop to grow alfalfa grass in his mixtures. So this is what you could have for coverage if you're in the program. If you've been reporting and you haven't selected it, hay for coverage, you can go look, and we're hoping to have it in the next 2 weeks, our confirmation of insurance, which gives you every crop, if you're in the program, every crop that we have and what you're covered for this coming year and the tons. So last year when I did the stock talk, I showed you what the areas and different forage types are. This forage regions 2, which is in the Grandview, Dauphin, Parkland areas. So yeah, there's really interesting numbers. And what some people also look at is they always look at just the alfalfa thinking it's the highest. Well, this producer normally grows alfalfa grass, and that's why he's got more coverage for alfalfa grass than alfalfa, because he records it when he establishes it properly, and it shows those numbers. So those are some highlights of what you can do by reporting your forage insurance correctly and keeping accurate numbers along the way. And I'd just like to mention again is, if you're not in the program, reach out within the next couple of weeks to a service center near you, and they can walk you through how to get into the program and actually give you what your numbers will be to start the year. Once again, this is 2024's numbers because 25s aren't out to print yet. So with that, I'd like to switch gears and talk about livestock price insurance. And exciting times, crazy times, but what we know is there's been more interest in livestock price insurance this year than ever before. Is it because of the high dollars? Is it because of the record prices at the auction mart? Is it because of uncertainty? Probably everything. So what do you need to know if you want to look at getting a policy? Well, we just started here the 1st of February on calf policy, which is based on 550 to 650 weight animals at the time of expiry. And a calf policy runs from now till the end of, or till June 12th, sorry, that you can buy a policy. The feeders run pretty much all year round with a few blackout times. that you can't buy a policy, but it gives you that option. So basically, a feeder is anything that's a weaned off the cow and runs from that 750 to 950 weight. You can have lighter ones if you want. We understand that sometimes that fits your market, but whether you're putting them on grass or you're backgrounding them or carrying them over right till fat, you can buy a policy to represent what you're doing and look after it. What we've seen in the last year and a half is we've seen a lot of people, producers, clients that were in the program early on, signed up, were getting the subscription, had everything, they could log into their accounts. In the last 5 years, Alberta AFSC manages the program for us, and they did an update. If you hadn't done anything in the last 5 years, it actually canceled your subscription, which isn't the end of the world. It just means that you could log in, but you weren't able to actually buy a policy by doing it online. So if you haven't done anything in the last 5 years, contact your local MASC office and they can reactivate it. There's no cost, there's no issues. It's just to make sure that when you want to buy a policy, you're able to log in and do it yourself. I sound like a stuck record, but I think one of the biggest things we need to do is if anyone has any interest on livestock price insurance, one thing you have to do is go into the lpi.ca, premiums and settlement tab at the top, and sign up for the daily emails. This is going to be the main thing to get you to understand the program so that you're getting the emails to see every Tuesday, Wednesday, and Thursday what the premium tables are on the feeder, the calf, and the fed, and then start to understand how they change daily. And then we'll hear more about that with the presenter after me about what's going on in the markets and everything. But when you get the emails, you can see how a premium changes to the index and everything along the way. So I do want to make sure you understand that if you go to the lpi.ca premium and settlements tab, sign up for the daily emails, and that'll help you get to understand the program as well. Where it's been at, what's it doing? Well, this is the last thing I wanted to show you here, just as an example of the calf, because I think that's the main one that everyone's looking at right now is the calf index. So from what I said before, this is what you're going to get emailed to you when you sign up for it. It's going to come from Livestock Price Insurance. And here's the SASC MAN premium table for the 11th of February. And at the top, we saw 426 at a 1262 premium per 100. Everything's in hundredweight. So you're looking at 426. And if it's on a 6 weight, you would times your premium would be times 1262 times 6 if you want to do a 6 weight calf. You don't have to do the top. That's why the index on one side has all the options. You can go down to a 400 or a $4 premium basis 6 and cover you for $2,400 a calf at 674, which is $37 per calf and change. So lots of options, lots of ways to look at what you want to mitigate your risk and where you think it's going. And I wanted to make sure you're aware of where we are starting. The last thing I want to do is I know these premium values, if you look at 12, 11, upwards of $14 the week before for a 430 were expensive. I just wanted to give you a little look into the past and let everyone see what and where we were at if you haven't had a program yet. So these numbers are numbers of that I know the screen isn't just perfect, but unfortunately this is personal information of my own that I want to share with you. And from the previous screen, the two numbers you're looking at is the first, it's inverse from the premium table before. So that my premium, what I paid is on the left, and on the right is the insured index that I had taken out since 2014. And just about every year I've had a policy except for one. And I just wanted to give you the experience of what it looked like, where it's been at, where it's going, and how this thing looks compared to what you're looking at for today. The highlighted ones were years that there was a payout. And I'm just going to highlight one because I wanted to give you a good example of what was, if you look through it and then you look at what the premium rate is and how it varies from year to year, how it varies during the year. And that's why I asked that you sign up for the premium emails so that you get to understand what it's doing and what's changing it. Right from the get-go, we were at 270 per hundredweight for a 206. Not bad. Sounds pretty good. But if you look down to the middle of the screen and you see the 904, $9.04 per hundred is what I paid in a premium for 232. If I go back to the screen before, we're at 1262, I believe it is, for a 426. Today, there's more money in coverage per every dollar spent in premium at the 426 than there is at the 904 on the 232. So that for every dollar I spent in the year that it was 904, I was getting $25.66 in coverage. I took it. I was worried about the market. What's interesting enough is that was the highest payout I've ever seen in the program as well. And that's why I highlighted it. The biggest premium I ever paid me the most back. Who knows why? It was just the way the markets were going. It was a downward trend. We had a high at the start and it went from there. But at 426, at a 1262, it's $33.75 for every dollar I'm investing into a premium. So even at these high numbers, which per calf seems crazy at times, there's still more coverage just because of where this thing's going. And you look right from 2014 throughout the whole program, we were at 206 start, and you look down those premiums and the indexes and what we're at 384 last year, 308 the year before, and now we're at 426. I don't know who would have thought we'd get there, but it's good times in the cattle industry, and I'm glad we have this option. So with that, I'd leave it to questions, or if Sean, you want to kick it out to questions after Brenna's done, that's fine. But that's just some of the things I wanted to highlight with price insurance and forage for today.
Thanks, Jeff. No, we can take some questions now. And I guess one that I had was, so if someone's backgrounding their calves right now, they're not going to be selling them for another month or two. And with all the volatility that's happening out there, what options do they have under maybe the feeder contract?
For sure, Sean. That's a good one. And that's probably one of the largest or most consistent questions I've been receiving in the last month and a half. And our shortest week period that we insure for is 12 weeks out. So the understanding of the program is you have to have your 100 weight at the end of your expiry date. And the other thing is to own the calves for 60 days or the feeders for 60 days within the program. So you can take a policy for that out, but understanding your expiry date, as long as you own the cattle for those 60 days, you're fine. So if you're going to sell them before that, it is a little bit of a gray area, and it's something you definitely would have to talk to an insurance specialist about. But yeah, absolutely. We've had more feeder cattle purchase a policy since December 1st than we've ever had at this time of year in the whole 10 plus years program's been out. And we're seeing more and more look at, and what's really interesting too is from the toppest or the highest index price to the lowest is getting purchased just to protect at whatever levels they feel comfortable protecting at. But so yeah, to answer the question, our shortest policy length is 12 weeks out to 36 weeks, Sean. So if you're going to, from today, if you're going to have those cattle for at least 12 weeks, you're perfectly fine at doing a policy. If it's under that, you should contact one of our insurance specialists.
Yeah, I know it's a pretty good option. Now I was just looking at the numbers a couple days ago, and so at a insurance price of $350 for an 850 weight, that would give a producer coverage of $29.75, and his premium at that time was just over $40. So he's receiving coverage of almost $3,000 for the premium of $41.50. So
yeah, the numbers are just really strong right now, and that's probably what's driving it is $40 policy to guarantee those. If you haven't priced these cattle, what is saving you from any uncertainty, right?
Yeah, and the calf coverage is good for those calves that are going to be sold in the fall time, or that you're thinking maybe holding on to past that. But thanks. Just ask Pam, did she have any questions for Jeff?
There are no other questions, Sean.
Okay, thanks, Jeff. And I guess the deadline for the forage insurance program is end of March that producers can sign up by if they don't already have a contract.
That's right. If you don't have a contract, or if you don't have forage insurance selected for insurance on your contract, the deadline is March 31st. So yeah, check your numbers, look at your confirmation if it comes in the mail. If not, reach out to a local service center and ask the questions you need to.
Great, thanks, Jeff. So our next presentation, we'll look at a cattle market update and outlook for 2025. And we have Brenna Grant with Canfax. And Brenna's been in Manitoba before, and we've had her on StockTalk in the past. So I'd like to welcome her again to our webinar. And I see your presentation is coming up. So I'd like to hand it over to Brenna.
Thank you, Sean. Well, we're living in confusing times. We're not sure if we're supposed to be excited about record high prices or a wee bit depressed about potential US tariffs. So I want to spend some time today just explaining why we have record high prices and the current market environment. I'm going to get to tariffs, but it'll be a little bit further in. And we're going to start with a global look of where things are at. And this really just shows global GDP and how it's grown historically over the last 50 years. That's those dots in green. And the fact that it's got a high correlation with beef, pork, and poultry consumption globally. And when we look out to the next 10 years, forecasts are that global population growth is going to slow slightly, but that GDP growth is actually going to accelerate and grow faster in this next decade. And this is really important because that's a really key driver to protein consumption. And with that, even if you sort of say, okay, we don't think the last 50 years is an appropriate trend and we're going to actually fade this down and have smaller forecasts for beef, pork, and poultry just due to animal welfare concerns, impact on the environment, just a general anti-beef sentiment, you still have the consumption bars here, which are in orange, showing very strong growth over the next decade. And the big thing here, though, is when you compare them to what the FAO is projecting for supplies, that's in the blue bars, you can actually see that the expectations are that we are going to fall short of providing livestock protein globally. And this is what is expected to be supporting and increasing prices moving forward. In fact, beef is the only one here that is expected to actually meet that consumption and demand number. But I also want to point out that the yellow numbers on the inside of the blue bars, that is what the FAO had been projecting for supplies 18 months ago. They revised them. The reason they revised them is that a helpful nutritionist came along and pointed out the fact that if you shorted the global population that much protein, you would have disease issues on your hands. And so they revised all of them up. But even with that revision up, we're still expecting shortages, particularly for poultry. And so when we think of this, of a really strong demand situation globally, we can look here at global beef production and see that really from 2007 right through to 2020, global beef production was basically flat. But in the last 4 years, we've seen that growing again with more supplies becoming available. We've actually had larger production in South America and Australia that's offset that steady to smaller production in North America. And that means that the record high prices that we're having globally are happening with more supply. And that really showcases the strong international demand we have for beef. And so when we switch and look closer to home for Canadian beef demand, I want to take a moment and talk about population growth. Historically, Canadian population has grown by 1% per year. In the last 2 years, that's jumped to 3%, or 2.4 million people in the last 2 years. And yes, a lot of these people are immigrants that don't eat like you or me in terms of the average Canadian, but they still have to eat. And this is one that if you think about someone coming to Canada and starting to adapt to Canadian food culture, and maybe they're going to have a quarter-pound hamburger once a quarter. That would add an additional 2.4 million pounds of beef demand to our Canadian market. But of course, those Canadians need to be able to afford it. And that brings us to the fact that Canadian real GDP per capita has basically been flat since 2019. And that really is impacting our domestic demand for beef. And Stats Canada isn't projecting for GDP to get back into trend line until 2032 or 33, sorry. And so this is one that GDP is a major driver of beef demand, both domestically and globally. But we can see here that in terms of what we're supplying to the Canadian beef market is it's been steady to lower instead of growing with that population. And that means that our per capita consumption number is smaller. And this is one where there is room if there was more affordable beef or larger supplies to actually grow this domestic market because the people are there. But that brings us to the supply situation. And this is work that's done by Matt Makins. He does a quarterly weather outlook for us. And one of the things he's been talking about is while we're moving into a La Nina sort of a time period, strength really does matter. And we've actually been fluctuating between a neutral weather system and a weak La Nina. And when you look at those two columns on the left and in the center, you can actually see the differences and the fact that it has been volatile with that weather pattern that we've been experiencing, both in terms of moisture as well as temperature. But when we look in at what he's expecting through this springtime period, the top ones are February through April. He's looking at, higher than average temperatures, particularly in Saskatchewan, Manitoba East, and then spotty moisture in the prairie provinces. But then when you get into the summer, you're seeing really just above average temperatures across the board for Canada. And you can also see Saskatchewan and Manitoba having this growing dry region. And so this is one to keep an eye out for. We know that our spring moisture and rain is really important for us in Western Canada. And the fact that things really can dry out quickly and timing of how quickly that dries out over the summer months is going to impact crops. So looking at grain prices, we did see a lot of grain prices make their bottom in September after harvest, and they have been steady to inching slightly higher just recently. And part of that came with USDA, and they did a revised yield for US corn back in January. So corn production in the US was lower than expected, and that reduced ending stocks. In terms of our feed cost advantage or disadvantage, in the West here in Alberta, we have been at a disadvantage to both Ontario as well as the US, but particularly against Omaha corn, we've been seeing that narrow and are now down around $35 a ton. Ontario continues to have the cheapest feed available in North America. So looking at supplies, one of the things I want to point out here is the cattle cycle. And if you look at our peak back in 22, we have been getting incrementally tighter in terms of where we're going. And our expectation is that we will actually revisit the low that we saw in 2015 at some point in this current cattle cycle, just due to the reductions that we've seen in beef cows in North America. But you can also see that from 2008, that previous peak down to the bottom in 2015, we had 7 years top to bottom. So there is time and there is runway ahead of us. We are expecting supplies to continue tighten for 25 through 27, and depending on whether and when that moisture comes to expand the herd. But then we actually had that big rally from 2015 to 22. So that was another 7 years. So from peak to peak in our last cycle was actually 14 years. And so this is one that when we talk about relatively tighter supplies, it's comparing against that peak in 22 and the fact that we actually have a lot more tightening that we are expecting to happen in the future. One of the things as we've seen those supplies tighten in North America is U.S. packer interest in Canadian cattle. So we've seen fed cattle exports to the U.S. last year, the highest since 2010. And that's just U.S. packers wanting to optimize their utilization. And so we saw a big jump there, but with reduced cow marketings, we saw that basically steady and slightly smaller on the cow and bull side of things. And so last year, back in May, we saw those rains and we saw a really big shift in cow marketings. Basically from May on, we saw cow marketings down 20%. And that really showed up in our culling rate that is really now the smallest since 2015. And this is really important because the first step to seeing a shift in the cattle cycle is to stop liquidating. And so this is step one, stopping the liquidation. But we need to remember that stopping the liquidation doesn't necessarily mean that we're moving into expansion. In order to have expansion, we need to actually see heifer retention. This shows heifer placements into finishing feedlots. And you can see that in the first 3 quarters, in 2024, that's the red line, we were below 23. So just incrementally smaller placements into feedlots, showing that interest in retaining heifers. But then in the 4th quarter, when you saw those placements of heifer calves, it actually jumped up and was higher than 2023. But you can also see that there's still movement to go in terms of reducing those heifer placements with that green line of 2015. And the expectation is that over the next few years, as we see weather conditions improve and as producers have forage available locally on their farm, that we will move closer to more heifers being retained, but it's going to take time. And right now, while we saw a small increase in the January 1, we're expecting to see a small increase in the January 1 breeding numbers. What we saw last July really wasn't enough to actually increase beef cow female numbers. So a big part of our supply situation actually comes from our net feeder trade, and we became a net importer of feeder cattle back in 2019. And net feeder trade is really important. It provides flexibility in terms of matching our supplies with demand seasonally. And one of the things that we saw in the July 1 inventory report was the fact that our supplies of steers and heifers over 1 year old, those yearlings, were basically steady with last year. And so those were expected to weigh on our 4th quarter and 1st quarter fed cattle marketings and really contribute to a weak basis. And so it made sense to actually export some of those south. In contrast, the calf crop was expected to be smaller by about 94,000 head. And so it really made sense to have feedlots export yearlings and import calves. And we can see that with the big jump in November of basically seeing that happen. And overall, this means that we've almost completely offset that smaller calf crop with these numbers, and therefore are expecting to have more steady supplies available here in 2025. One of the big parts of the supply story is we need to remember that our cattle cycle is driven by pounds of beef produced and not just number of head. So while we saw that slaughter number with shrinking numbers, some of that's being offset by heavier carcass weights. And so you can see here last spring, we had carcass weights up over 30 pounds above the 5-year average. And then in May, we got current and stayed current throughout the rest of the year. In contrast, the US, that chart on the right, they actually started adding more days on feed in February and had about a 20 to 25 pound increase year over year throughout the rest of the year. And now here in January, February, we're seeing carcass weights in Canada and the US very close to each other within about 5 pounds. And so this is an improvement in terms of having supplies and leverage more even on both sides of the border. But those larger carcass weights and the jump that we've had that's offset smaller numbers, the question becomes, can we actually do that again this year in 2025? And when we look historically, when we start to see supplies tighten, there really is an incentive for feedlots to add more days on feed. They have the genetics and they can really adjust to market signals. And back in 2015-16, we saw 2 consecutive years of a 30 and a 20 pound increase year over year. So that possibility is really there. We did see a 22 pound increase last year. But what's going to happen this year for carcass weights is really going to depend on how cattle move through the system and if we're able to keep current. And so this is overall what we're looking for production to be in 2025. You know, it's really steady, maybe slightly higher, really depending on those carcass weights. But you can see historically, and I want to point out that if you go back to that 2008, 09, and 2010 time period, that after peaking in 08, you saw that dip, and then you saw that jump back in 2010. And that was due to those longer days on feed, heavier carcass weights. But there does come a point in the cattle cycle where in order to keep moving cattle, you have to actually pull them forward. So you go from heavy weights to actually pulling cattle forward and you get lighter weights. And that's where we got the big drop in 2011. And so that's something that's still ahead of us in this cycle. So before I get into prices, I do want to spend a few moments talking about the potential of US tariffs and what does that mean and how do we think about it. So the first thing I want to address is that a 25% tariff does not necessarily mean a 25% drop in prices. And the reason for that is that with a tariff, it is expected that there would be a higher US price. This would be slightly higher because Canada and Mexico are a very small portion of US beef consumption, but it is expected to contribute to a higher price in the US market. The other piece is exchange rate, that with these broad tariffs that are being proposed across multiple commodities, this is not like a targeted tariff. And so with these broad ones, there are expected to have exchange rate impacts. So a stronger US dollar, but also Canada would be expected to potentially have smaller or reduced economic performance, contributing to a weaker Canadian dollar. And so this exchange rate effect has the potential to offset some of that tariff. And right now, Rabobank is projecting that the further move in the exchange rate could be anywhere between 7 and 12%. And so that is substantial. It still means that there would be a significant price impact, but it is a substantial piece of offsetting it. Now, a weaker Canadian dollar isn't necessarily all good. We've got to remember that for anyone who has been importing US corn or DDGs, a weaker Canadian dollar is going to make that more expensive. And as we saw, those price differences on cost of gain for feed are getting closer. And so we may see a shifting away from those US products. But the other piece, and we talked about the fact that GDP has a big impact on beef demand. And so for the Canadian market, that would also contribute to the price impact. But we don't just have the economics of how does a tariff work. A lot of this actually comes down to the reality of how the players in the supply chain actually respond to a tariff. And this is really going to depend on if they have short-term or long-term impacts or expectations. So if a packer expects that this is going to be a short-term tariff, maybe it's part of negotiations for CUSMA back in 2018. In the first Trump administration, we saw tariffs go on for steel and aluminum, and 4 months later, when CUSMA was signed, they were dropped. So as well, if you go back to the Nixon shocks of 1971, when the US put a 10% tariff on the world, they lasted for 4 months and then were dropped. And with this, if you're expecting it to be a short-term impact as a packer, you may say that you want to show that your US clients that you are a reliable supplier and that you are going to continue to ship product to them and that you're going to take the price hit. But that also means that we will continue to see product flowing through the supply chain. The expectation of a long-term piece would be that in the Trump's first administration, he put tariffs on China. And when Biden came in, they actually maintained those tariffs. There was bipartisan support from both Republicans and Democrats for those. And so if you're expecting this is designed to change trade deficits and have reshoring of industries back to the US market, that then changes strategy to say maybe there's advantages to actually shifting product away from the US to other countries like Japan, Korea, or Southeast Asia. There will also be exchange rate impacts that may actually make Canadian product more attractive in the international market with this. But this is one of that's individual packer decisions that are going to influence those based on their management decisions. There's also questions of what feedlots are going to do in terms of feeder cattle trade and filling pens. So these are trade-offs that every player is going to have to consider. And the expectation is that if it does come into place, that it will be very messy, that there will be lots of volatility and lots of uncertainty as players figure out what they're going to do and what their strategy is going to be to respond to it. So moving forward, I'm going to talk about prices, but right now, all of our price projections are assuming the fact that there is no tariff today and that there won't be a tariff until that actually happens. And to start with, I want to talk about the Canadian dollar because I noted that that could have an offsetting impact on overall prices. And we did see a 6% weakening in the fourth quarter when it started to become apparent that the Republicans and Trump would win the election. And so there have been questions of how much of those tariff expectations have already been built in to the exchange rate. And one thing we did see with the announcement on February 1st is that the dollar lost about 2 cents. And then when it was delayed by 30 days, we rallied and regained that. So that's something of we do know that there will be some continued movement. We're not sure how much, but what we saw last fall really contributed to our feeder price rally by over 40%. So looking at cow prices, we've seen smaller cow marketings and therefore a really tight lean manufacturing trim market with really high prices supporting the cow market. And historically, from January through spring peak in about May, Western Canadian cow prices rally about 33%. And that would really put Alberta cow prices at about $250. Now, we don't expect to actually hit that 250, but we are expecting historically strong cow prices throughout this year as we have those tight supplies of lean manufacturing beef. We actually saw a premium for 85% trim through most of the summer last year, and that disappeared in the fourth quarter. But during that time that we had a premium, we were attracting imports of lean manufacturing beef from countries like Australia and New Zealand. So before I talk about fed cattle prices, I do want to note leverage that shifts throughout the cattle cycle. And this chart goes from 2015, so that was the previous low when feedlots have the most leverage against packing plants. And as supplies increase, you actually see the feedlots leverage decrease to a low here in 22 when supplies were at their highest. Now, we've actually regained a lot of that leverage in the last 2 years. We're back at levels that were seen back in 2016 and 18. But we are expecting, as we go into the tightest portion of this cattle cycle, that we'll get back to that 60-65% range that we saw back in 2015. And so when we look at Alberta fed cattle prices, we did see a more seasonal year last year, but with a stronger second half of the year, which is typical as our supplies shrink throughout the year and they get incrementally tighter year after year. You can see where we're starting here in January is historically high, and what we're projecting based off of the futures market and a historical basis is in those orange dots in terms of a more sideways movement with some seasonality with it. This is one where when you look at what feedlots are paying for feeder cattle, it really appears that feedlots are expecting more price support in the second half of the year with tighter supplies than what's being shown on this chart. But you can also see the livestock price insurance coverage. This is top coverage levels in the green line that are very robust, well above year-ago levels. When we look into the yearling market in terms of heavy feeders, again, we're looking at very strong prices here in January and a flatter market projected throughout the year. This is very similar to what we saw last year in the first quarter of the futures market, really looking at more of a flat expectation and livestock price insurance mirroring that. But I do want to point out that we did see in terms of cash prices, it wasn't a full seasonal rally in that blue line. We sort of got flat there in the summer portion, but we did get that kick in the fourth quarter with the lower exchange rate. And then moving on to calf prices. Calf prices were really sitting around that 425 for most of the year last year. We then had some really disappointing news in August around demand, as well as a number of geopolitical announcements that were made that we saw prices drop in August and September. And then we started to get that kick from the exchange rate, but also stronger live cattle futures as well. And so that combination really saw a rally throughout the fourth quarter to make that high at the end of the year around 475. And then we came back in January and had a 50-cent jump with prices starting out at 525. And we've seen some weakening there, but prices have just been tremendously strong. We saw larger volumes at auctions here in January ahead of the tariff announcement, as we saw some of these guys that retain ownership and do preconditioning or backgrounding take their profit to avoid the risk. So looking at breeding stock prices, just as this is going to be really variable depending on your region, if you have rain and moisture and forage or not. But we've seen tremendous rally here in the fourth quarter of last year with bred heifers and bred cows averaging over $4,000. One of the things we like to point out to producers is to just keep in mind that historical price relationship that we've had where, you know, bred heifer price would be, you know, 39% over what a 550-pound steer price would be. We have seen that increase to about 68% in the fourth quarter of last year. But this is one where we're still not at the real big highs in terms of price relationships that we saw in 2015. And I just want to remind us that we don't have to repeat what happened in 2015, that sometimes expectations can get away from us. I actually obviously removed the slide and hid it, but I do want to comment on the fact that we want to make sure that what you're paying for bred heifers and bred cows, if you're in a position to expand and restock, that you are considering what your cost for annual maintenance of a cow is. We've done some work with our Canadian cow-calf cost of production network, with our low, medium, and high cost groups, and it creates a big difference in terms of willingness to pay for bred heifers and what those bred heifer prices are. And so knowing your numbers is really key here, of knowing what's going to give you a return. The other piece of this is to remember that we always overshoot the market, which means calf prices at the tightest portion of the cattle cycle are not what you can expect for the lifetime of that breeding female. And last time we saw those prices come down about 26% from the high that we saw during the top 3 peak years. And so whatever you're doing for numbers in terms of expectation, remember that the peak doesn't last, and that you need to consider how long you're going to have that breeding female. So just in summary, we are expecting North American beef supplies to be tight over the next 3 years. And that is going to be price supportive, with strong markets this year and next year. But we are expecting a lot of volatility with geopolitics, and just really until CUSMA is renegotiated and clarity on tariffs is seen. But we need to remember that risk management is really important at these record high prices. And so I'm really glad for Jeff's presentation earlier. And just remember that demand in the last 20 years has really been driven by AAA or higher grading, and being able to provide that consumer with a consistently good eating experience. And this is one where when you have that higher grading, it's just more forgiving in terms of not needing a really good chef to actually do a good job at the barbecue. So with that, I'd be happy to take questions, Jeff.
Sure. Thanks, Brenna, for that great presentation. The U.S. cattle herd is the smallest since 1961. Do you see the Canadian herd following in declining numbers, or what's the appetite for heifer retention, I guess, out west, where we have the lion's share of the cow herd?
Yeah, so I'm going to actually answer that in 2 parts. So one of the things to remember is that while the herd has been shrinking, what that means, the peaks of the cattle cycle in terms of beef cow inventories is lower with every cycle than it was in the last cycle. And the reason that's driving that is carcass weights, of the fact that we don't need as many beef cows to supply as much or more pounds of beef to the market. And so that's been a long-term trend in the US. Canada, we really expanded in the 90s in terms of our grassland availability and what is appropriate for beef production. And so as we're seeing more conversion to annual crops, there's that opportunity to see a smaller herd moving forward. This last cattle cycle really was driven not by cow herd expansion, but by imports and becoming a net feeder importer. And that's how we got our cattle cycle in terms of our slaughter and beef production numbers. And so that's just one of remembering that carcass weights really do influence that inventories number. But in terms of heifer retention, this really is weather dependent. And this is one where there's a lot of variability. There are definitely producers out there that are retaining heifers and are going to be able to do that. One of the things we saw last year is that there was absolute interest by producers. There is the price signal to retain heifers, but in April, when they didn't have rain, they then actually marketed them and they ended up going into feedlots. And so that's something that we're watching for this spring, is what happens throughout the spring of, are cow-calf producers able to retain those heifers, or do they end up going to the feedlot at a later date?
Thank you for that. Manitoba, we have high land prices, and part of it's being driven from grain production. Is that happening in Alberta as well, where we're seeing the high grain price, and it's making it uneconomical to run cows on some of this land?
So I would have said that previously, but we've really seen an adjustment in grain prices here in the last year to 2 years. And it's really meant that the conversation has really changed. We've seen beef cows more profitable with these record high prices, whereas the grain guys are actually struggling with high equipment costs, high land costs, high fertilizer costs. And so this is one that we definitely had been seeing land conversion prior to that. Some of that seems to be on pause at the moment. I'm not just not hearing as much of it anymore.
Okay, thanks. Question in our chat, and just like to remind participants, you can enter a question into the chat. And so the question is, what are your thoughts on the USA bringing back MCool?
So they have been talking about voluntary country of origin labeling for quite a while. It is scheduled to come into effect January of 2026. And this is one that we know, when mandatory country of origin labeling was in place, that there were a number of packers that saw the benefits of it, of going to a straight 100% USA product. And the expectation is that under voluntary label, that those plants would absolutely do that. The difference between voluntary and mandatory is really, really key in terms of not requiring the segregation at US packing plants that rely on Canadian cattle, which is so key for arbitrage and price movement across the border. The real question is, does voluntary become mandatory at some point if it starts in a voluntary? And I think with that, we need to remember that Canada has retained its right to retaliate under the WTO case, because Canada did win that case, and we do have retaliation privileges.
Sean, you just need to click on your display settings again to swap presenter view.
Okay, thanks, Aaron. And I don't think we have any other questions. So thank you to Brenna for the presentation, as well as Jeff Legaarden for the update on the MASC insurance and livestock price insurance programs.
It's still not displaying quite correctly, Sean.
Yeah, I'm looking for the right setting.
So right at the top where it says display settings, that drop down, the top middle. Where it says taskbar, show taskbar, display settings, and slideshow. Do you see that? You might be looking on the wrong screen. Okay, press the from current slideshow on your. Oh, I don't know what you're looking at.
Yeah, it
I
doesn't
just
seem
see
to.
all of your slides right now. There we go. Perfect.
Is that better then?
We're perfect.
All right. So thank you again to our presenters. So our next Stock Talk will be March the 13th. We have Ask the Vet, calving tips and dystopia from Dr. Shania Jack at the Morden Vet Clinic, as well as results of the Western Canadian Cow-Calf Survey with Dr. Reynold Bergen. And then our final Stock Talk will be on April the 10th on range and pasture health and native pasture management. So hopefully you can join us on March the 13th. Just wanted to mention, if you're looking for calving books or livestock manifests, Seed Manitoba, livestock and forage fact sheets, cost production for beef or crop or more, stop by the nearest MASC or Manitoba Agriculture office. We do have a number of livestock and forage specialists across the province, as well as crop specialists to answer any of your crop production questions. So that concludes today's Stock Talk, and thank you for joining, and we'll see you next month on March the 13th.